Keller Williams Realty, and with me, Katie Andy with Interlink Mortgage. And today I wanted to ask Katie, who is a loan originator, what can she tell us about the recent increase in the interest rates and how it is impacting the home buyers?
Absolutely, Elena, and thank you for having me. So yeah, big news in the last 3 or 4 weeks is rates are trending up. We do expect that to continue. And one thing to understand is that the economic strategy set out by the Fed to keep the overnight lending rate between banks at a low amount has not changed. They've actually said that they're going to continue to do that well into 2022, possibly first quarter 2023 at this point. So the Fed has not actually changed their stance and their strategy. But what buyers need to understand is that the Fed rate, the overnight lending rate between banks, is not a direct impact and correlation on mortgage rates.
Mm-hmm.
Mortgage rates are set by the demand on the 10-year treasury bonds and mortgage-backed securities.
Mm-hmm.
And so what we've seen in recent weeks is there are concerns with investors who are buying mortgage-backed securities. There's concern for inflation and devaluation of their portfolios because of the high demand on money. And it just can't keep going at that rate. So a healthy market is always going to support rates in the 5-6 range, right? That's a healthy market. The only reason we've seen rates so historically low is because the Fed is using our taxpayer dollars to buy mortgage-backed securities to help keep the market low. The market is saying we can't keep doing that because of concerns on inflation. So investors are making those adjustments. They're making them now.
Mm-hmm.
And so rates are going up. So just within the last 30 days, I mean, you could get rates still, under 3, low 3s, even possibly down into the mid 2s with a rate buy down up until about the last 3 or 4 weeks. Now getting anything under 2 is very challenging at best. It's going to cost some money up front. Depending on your credit scores, and I'm going to just kind of go deep here. So depending on credit scores are one element in determining a borrower's rate. So there's a lot of different things that go into it. Loan program, are they government? Are they conventional? VA, USDA? Is it a down payment assistance? All of those different programs have different rates, and all of them have what's called loan level price adjustments, depending on where credit scores are, depending on loan to value, how much they're putting down and compared to what the purchase price is, what their debt to income ratios are, whether it's a 30-day lock, a 60-day lock, or a 180-day lock. All of those things go into pricing out a final rate for each individual client. So a lot of times, and especially you'll see this with online lenders, you'll see these cheap rates advertised.
I do see those cheap rates,
Yeah. And the reality, though, is what if they look at what's actually being locked in on average, it's not those low rates that are getting the phones to ring, because most buyers typically fall in, moderate, credit scores, right? So we as a lender, we go down to as low as 580 on FHA financing, right? But we have different credit score loan level price adjustments between 580 and 619, and then from 620 to 639, 640 to 679, 680 to 719, and then 720 and above. On conventional loans, you really have like every 20 points, you're going to have a loan level price adjustment depending on the score. So conventional loans are typically going to score harder as far as your pricing for the credit score. FHA is not quite as hard. You have a little bit more room, and the loan level price adjustments aren't as high, but that's because it's a government insured loan. So those are kind of the things that we're looking at. Buyers can still get a lower rate, in those 3s, but they're going to pay some upfront money in the form of discount points for that loan level price adjustment, because the market is still saying, well, we don't necessarily want to put people up at real high rates right now, because rates are going to continue to be low for the next year or so, right? They're going to be lower. And so we don't want to put them at a high rate right now and then potentially have them refinance in 6 to 9 months and have an early payoff, because servicing investors are in it for the long game. They're not in it for the short game. They're in it for making the interest month over month for 30 years. So what they do is they'll go ahead and do the lower rate, but those buyers and lower credit scores, they've got to put some more skin in the game. And that's going to be in the form of discount points. And so depending on that credit score, it could be, the cost is going to be dependent on that. So it could be anywhere from 1 point to 3 points to 4 points. I mean, it really just depends on the credit score and where they need to be for qualifying and what their debt to income ratio. So there's a lot of moving parts. So the main thing that I could say is any buyers who are looking to purchase right now, they just need to work with a qualified lender. They need to talk to somebody who really understands what's going on with the market, and so that they understand what their cost on their loan is going to be based off of where they fall within those credit score models. And most lenders have the ability to do, credit simulations and kind of see if there's different ways that buyers can pop up scores. But lenders are not credit repair agents, so we can't guarantee scores are going to improve. All we can do is just kind of say, hey, these are some possibilities, but ultimately it's the buyer's responsibility to work on those steps to pop their scores up. But right now, I mean, we're still lending money. You can still get financing approved. And as far as people who are on new construction, because I know that's one of the things you had asked about too. Some lenders do have extended rate lock programs. We're actually in the process of rolling one out for our new construction buyers. That's up to 6 months. It's a 180-day lock. Now, the thing with an extended lock period, okay, because the investor is now guaranteeing that rate for an extended period of time, regardless of what is actually happening in the market. So most extended lock programs are going to have some form of upfront lock-in fee that may or may not be credited towards your bottom line. It could be a hard fee, or it could be something that's credited towards their closing costs as a prepaid that you've already paid in, kind of like your earnest money or appraisal money. Most of them are non-refundable. So if they cancel the contract, if they don't close within that lock period, then they are risking that money. And right now with new construction times are taking longer than
they have hard time securing the wood, the parts and everything.
Permits are backed up, lumber's on shortage, brick is on shortage, labor is on shortage, appliances. And so, building a 2,000 square foot home a year ago would take, 4 to 6 months, and it's now taken 8 to 10 months. And that's just the reality. And the builders don't have control over that piece of it. I mean, they're working with their vendors and their suppliers as best they can, but we're dealing with unprecedented volume, both in the resale existing market as well as in new home builds. And so all of those things are kind of working together. It's a great market, but it is a very competitive market as far as for home buyers that are looking to get on contract. Most builders right now have wait lists. And, if you can get on contract on new construction, you do have to be prepared for the fact that rates are going to change between now and the time your home is built. So if your builder's lender does not have an extended rate lock program, you just have to know that you might be at 3.25% today, and it could be at 3.875 or 4 or 4.25, 6 to 8 months from now. None of us have that crystal ball to know exactly where we're going to end up at this. But if you're working with somebody who is staying educated and staying on top of it, you can at least get good guidance and advice. And none of it's going to be perfect. None of us have a crystal ball. If we did, we'd all be millionaires or billionaires. But really, the other thing too is you have to weigh the cost of an extended lock program versus just waiting until you're within 30 to 45 days of closing, because you are gambling a little bit by putting up that non-refundable upfront lock fee. And some of the lock options come with a float down to current market when you're within 15 days of closing, and some of them do not. So you're also locking a higher rate for a longer period of time with an upfront fee. For some people, that might make sense. For instance, right now, if you're an investor, we just got this news from Fannie and Freddie on Monday. Investors' loan level price adjustments effective April 1 are increasing. And this is across the board. This is across the industry. So investor money is going to be more expensive now. And also, if it's a second home, they've now added a loan level price adjustment for a second home, which historically has not been there. We've, if it's usually second homes had the same sort of pricing model as a primary residence, they've now added a loan level price adjustment equal to 1% on that, which is about 0.25% to 3%. It's higher in rate. So, it's the cost of money is going to go back up. as a healthy market should, but we are seeing some nuances right now that we haven't experienced before, especially with this increase in the loan level price adjustments for non-owner occupied. But part of that too is a lot of times these agencies don't want to completely do away with the program, right? But basically when they increase pricing like that and they increase the loan level price adjustments, it's because that's not the product that they want to be servicing. So they increase the price on it so it becomes less attractive.
Gotcha. Question. So let's just say that hypothetically, I have a couple who are shopping right now and they're looking at potentially either getting a new build. Let's just say that they're approved for 320 right now, right? And they're looking to buy either a new build or an existing build. Should my advice to them to go for an existing build, because I know that within 30 days we're going to close, and there is at least some sense of security that we know with their credit scores and they're not going to fall out of the contract, rather than going into a new build that they say will be completed in November, December, and we have no idea what's going to happen.
Yeah.
So
I mean, certainly if it's available, right? I mean, if you're looking at, two potential homes with a builder and they've got an inventory home that's going to come up and be ready in the next 30 to 45 days.
Yes.
That's a much safer bet than starting from dirt and building.
But let's just say that there is a lottery for the, those that become available, right? Let's just say that they put their name in the hat for the lottery, but what are the chances of us winning that lottery, right? Yeah. The much larger chance that they said, hey, we still have this in this phase, we still have this available. Do you want to sign a contract? And they ask me, what should we do?
I would say sign that contract right now in this market.
Sign the contract and just take a chance.
Yeah, if you can. I mean, it's challenging. I mean, everybody has kind of their own individual unique situation that they're dealing with. Lease agreements that they're up against, kids needing to start school, homes to sell, relocations. I mean, there's so many different scenarios. So all I could say is, based off of each individual client's specific need, is just guide them in the direction best you can. If you have somebody, and I'll tell you this, if you have somebody that's at the top end of their budget at 325 at a 3.25% interest rate, you need to try and get them on contract on something that's going to close in 30 to 45 days where they can get probably that rate.
Which is another.
If going up to 4.25% is going to kill the deal for them, new build is not the way to go right now.
Gotcha. So there is another kind of question that I asked them. So let's just say hypothetically that the new build that they want is not at 320, it is at 329, and they have the money, right? And we already calculated their closing costs and everything they can accommodate. But if the interest rates go up, then the deal potentially is being killed because their monthly payments are now knocking out part of their debt to income, right?
Yeah, and that's one of those things where, again, that's if they're at the top end of their budget for their debt to income ratio. And if the rate goes up 0.5 point, it kills the deal, then they shouldn't be in that price bracket right now.
Gotcha. So maybe my advice to them, and I'm just kind of hypothetically thinking, instead of going for, they're approved for 320, and instead of going for the stretch, they need to go for a safer amount. Let's just say something that currently is selling at 295. This way, no matter what happens with the rate, there's still enough room in their budget for them not to be killed during the interest rate increase, right?
Definitely. Yeah, that's a safer strategy. I mean, this is the thing you have to remember, or it's kind of a general rule of thumb. So when you're financing a home, for every $1,000 that your price increases, right, it's going to change your payment about $7 to $10 a month at the current rates. But for every 8th difference, so every 0.125 difference in rate, it changes your payment about $15 a month. So if you are at a 54.5 back ratio, and that's the highest the automated system will take it, and another $15 a month, another 1/8 higher in rate is going to make you lose your approval, then you need to be in a little bit lower price range right now. Unless you're willing to buy the rate down, assuming that a rate's low enough that you can afford to buy it down. Because I mean, we've had buyers, I had a buyer that we've been working on several different deals, and they're on contract again. But when they started on a home back in January that they ended up not closing on, they were able to buy down to 2.875, which allowed them to qualify for 310. Well, now they're only able to buy down to 3.25 for the exact same scenario. And so they're at 290. So that just kind of gives you an idea that rate, the change in rate has a greater impact than the change in sales price. And then of course, other things too that go into it is, you know, where are they looking to buy? What are the tax rates for that area? Is there an HOA? You know, all of those things factor into what that debt to income ratio looks like too.
Okay.
But definitely, I mean, if you've got them, lock them. That's kind of our strategy right now. So as we get contracts in, we aren't sitting on these floating for a couple of days to see if the rates are going to come down back down. Our advice is lock it in, because when the rates are trending up, they trend up so much quicker than whenever they come back down. You know, what we experienced last year with COVID was a bit of an anomaly. It was an unprecedented time and it was historical, right? And a lot of people really benefited from that, but we can't get comfortable in the fact that that's a forever market. It's just not, it's not sustainable. A healthy market based on supply and demand really should support rates that are between 5 and 7%. And we've been historically low for the last, you know, 10 years, ever since really the fallout in 2000 and the early 2000s. So really going on almost 20 years, we've been in historic lows.
So we got a little bit lazy and a little bit relaxed with that.
Well, yeah. I mean, whenever I got into the industry back in the late 90s, I mean, rates were 8, 9, 10%. So, I mean, when they came back down, you know, I remember they fell under 7%, I was like, wow, this is awesome. And then they fell under 5. And then I remember whenever they fell under 4.
Historical, right? It was historical at that time. Yeah.
Yeah. But the thing is for like millennials and people who are younger, who haven't experienced those higher rates, to them, you know, they think going from 3% to 3.5 or 4% is the end of the world. And it's not. I mean, the real estate is still a great place to put your money. And especially in Texas, where we still have so much land to develop and we are continuing to see good rates of appreciation, you're still able to borrow money at a very low amount. Historically, we are still seeing good appreciation. We are not with a shortage of place to develop still. There is a shortage of inventory in our markets right now, but that's not everybody's market. I mean, the whole state of Texas is very big. You have other parts of Texas that are not experiencing the same shortage of inventory that we are here in the DFW market.
Are there any types of buyers that are could be particularly affected by, let's just say that in the next 60 days it goes up again? Just if you could make a prediction, who would be most affected in this market?
Right now, for the next 30 to 60 days, those who are going to be most impacted by what's going on are going to be your non-owner buyers. So investors and second home buyers are going to be highly impacted, especially after April 1, because of the new loan level price adjustments coming.
Are they? Okay.
And then of course, buyers that have the lower credit scores, they're going to have additional upfront cost in the form of discount points to cover their loan level price adjustment. They'll still be able to get decent rates, but they're going to have higher upfront cost. And so they need to be prepared for that. And especially right now, whenever we are seeing multiple offer situations, I mean, really anything under 400,000, we're seeing multiple offer situations over list price offers. So if you've got a buyer who needs seller's assistance, this is not going to be a great time in the market for them. I mean, it's not impossible. I get contracts every day where a seller is throwing in some concessions, but that home could have sat on the market for 60 days. It's all about location too. You could move a little bit further out into the country and not be in the Metroplex, and you would have more inventory to choose from. So sometimes where you're buying also plays a part. But if you're wanting to be in McKinney, Plano, Frisco, Dallas, Richardson, you know, Salina, all of those, they are seeing such a high demand and there's just not a lot available. So you have over list price offers on existing, and then you have multiple people on wait list for new construction.
I have several buyers who are sitting on the fence saying, since last year, really, saying that we're just waiting to see what happens with the market. We're just waiting to see what happens with the market.
They're going to watch it go up.
Yes, they're going to watch it go up.
Yeah.
But I'm actually sending them emails saying, try to get under a contract before the next interest rate increase. because your buying power is diminishing by the day, not only by the rising prices, because every time a house sells over the asking, that goes up your cost of purchasing the next house, right?
Yeah.
But also you're getting hammered from both directions. The cost of the house that used to be at 235 is now at 257. That one that you were trying to look at 6 months ago. And
Yeah.
also the interest rate went from 2.3 that you were approved for. Now, if you try to qualify, you're probably going to be at 3.5.
Yeah.
So you're getting hammered from both directions. So what would you say to people who are still on the fence?
I would say that that is not the place to be right now. You know, if you're waiting for things to come back down, that's not going to happen. It's just not. I mean, really, I would almost say that the people who've been sitting on the fence have missed the boat. And
I tend to agree with you. Yes.
Yeah. I mean, this has been absolutely historic 12 months. I mean, if you look from March of last year to March of this year, rates had never been that low. I mean, we had buyers that we locked in at 2.25, 2.375, 2.5. And so just to put that in perspective, so that's somebody who's able to buy a $500,000 home versus a $400,000 home for the same monthly payment. So last year, out of the 22 years that I've been in the industry, last year was the year where you could get a lot more house. It was a lot more affordable, and you were basically getting it at the absolute lowest rates we've ever seen. We are coming out of that. The mortgage servicing investors, the investors who buy the mortgage-backed securities and the bonds, are saying rates need to go up. We are concerned about inflation, and we are concerned about liquidity, and we are concerned about sustainability. And it created such a high demand.
It did.
And so, which is great. I mean, so many people benefited from it. But if you've got somebody who couldn't make a decision, who qualified, now it's one thing if they're not qualified and they have to wait, right? Because there's plenty of people who wanted to jump into the market, but just weren't credit ready, maybe, less than 2 years self-employment, who knows, a variety of different things, right? But for qualified buyers who could get into the market and chose to sit and wait, that they've missed the boat. And so at this point, it's just a matter of, if now is always the best time to buy, because that's the only market we have. And I would not recommend, if somebody really wants to buy, they need to be serious and be ready to move when they find something, and then hope that they can get on contract.
But you do think that after April, only primarily people who are second home or investors going to be affected, or should the buyers who are trying to buy right now should be concerned about April as well?
No, I think that anybody looking to purchase a home should expect rates to continue to go up, period. But as far as a large impact that's coming, effective April 1, the loan level price adjustments on non-owner occupied homes, that's coming. That's regardless of what's going on with the regular market.
I might need to do a blast to my database to let them know in case they're not aware.
Yeah, but just keep in mind, if they're not on contract and within 30 to 45 days of closing, they can't lock in. So, I mean, I know that like with our builder, I think I've got about 17 investors across the Metroplex that are on contract on new construction that are in various stages. And our strategy.
But they cannot lock in, right, yet?
Well, that's what I've been talking to our capital markets desk about, and we're working on an extended rate lock option for them so that we can hopefully get the majority of those protected before April 1st. So so the next week, but those are people who are on contract, and if you're not on contract, April 1st is going to come, and it's just going to be what it is. I mean,
April 1st is only a week away, so
it's only Thursday. Yeah, I mean, I've got 4 investors and 1 second home on contract that the homes aren't even going to be ready till end of the year, and we don't have anything to cover that far out, so they're going to be subject to that new loan level price adjustment. But I would just say, I mean, to your buyers who are extremely payment sensitive, is if they're really that payment sensitive, they need to be looking in a lower price range. They don't need to be topping out at the top of the market, because if $50 is going to make a difference between whether or not, 1, they qualify, or 2, whether or not they can afford it, they're looking in the wrong price range right now with rates trending up. And I don't mean all of that to sound negative. It's just that this is the reality of the market. And I'd much rather be very transparent so that people understand that this is a reality. You know, mortgage lenders aren't like making it up. We're not trying to get people to just lock in willy-nilly. We are really trying to protect the people who are out there looking and help them understand and be educated on what's going on. But this is something that affects our entire industry. It is not lender to lender. I mean, we all have little variances in pricing, but for the most part, we all have the same rates available at very different, you know, margins, because everything's Fannie, Freddie, FHA, VA, USDA. There's very few private money portfolio type loans out there where there's much variance in pricing.
Question on variance in pricing. Maybe it's a stupid question, but let's just say I have a buyer who is qualified for USDA, FHA, and conventional, and they're going onto a new build that USDA qualified. Which program is the safest for them, if any, as far as the build taking 9 months? Which program should they use? You can't tell?
It doesn't really, I mean, it's really, as with anything, you're just going to look at whenever it comes time to lock in, because until they're within 30 to 45 days of closing, they don't have to finalize which loan program they're going with.
They don't?
No. Yeah. Because I mean, that's typically whenever you lock in is about 30 to 45 days ahead of your close date with your builder.
I thought that the buyer approval first need to take place, and if they're locking in their FHA or USDA,
but you're not locking in. You're not locking into that program at the beginning. We might approve you and underwrite you on one program, but the buyer can always change. Yeah, I mean, because we're not finalizing until we're within 30 days of closing. I mean, there's plenty of buyers that have started out going conventional and then worked on maybe improving credit and were able to get to USDA, or maybe they ended up not having as much money as they thought, so we had to switch them from a conventional to an FHA with a down payment assistance. So really, we need to finalize 30 days before closing. That's when we're going to finalize the loan, finalize the rate lock, finalize the program, assuming that they have a choice. So some buyers are fortunate enough to have their pick of program. Others may only have one option, and that might be it.
Right.
And so like I said, if you've got a buyer that FHA down payment assistance is their only option, and they're already capped at a 45% at the current rates, you're putting them in a risky situation to contract on a 6 or 8 month build job where that down payment assistance rate might be a 0.5 point or 3/4 of a point higher, and now their debt to income ratio is too high to qualify for the program.
Gotcha. Unfortunately, many of my buyers who do need a down payment assistance do go for those new builds because of the builder incentives.
Of course. But one thing I will tell you, a lot of these builders are not offering incentives right now.
Some still are. And
some still are, but it is harder to find. You know, 3 months ago, almost all the builders were still offering really great incentives. But again, because they've got to slow down the demand, the only way to slow down demand is to make things cost more. So you see that in the form of fewer incentives being offered by the builder, fewer upgrades being offered by the builder, fewer or higher cost on your rates, higher cost on the money being borrowed.
Lots are going up in price.
Lot prices going up. So all of that stuff is you can only control the controllables. And so when you've got people who are still willing to come and buy, even as you increase the prices, that does ultimately, values will catch up, but then you have potential appraisal issues too.
Yes, you do.
And that's a whole nother topic for another day.
Let's go in there now. Let's just resolve one issue at a time.
Yeah, well, yeah, let's just focus on rates. But yeah, I mean, look, now is not the time to be sitting on the fence waiting to see what the market's going to do. The market's going to go up. And regardless of the Fed's strategy to keep rates, the overnight lending rate between banks low, the mortgage backed securities and the bonds that drive mortgage rate pricing they're going up. They're going up. So
gotcha. Well, thank you so much. It is 5:35. I kept you for 15 minutes longer than I promised. So
it's a big topic.
It is a big topic, but actually the second big topic that I would like to discuss is how are the appraisal value is going to sometimes match up to the new prices, but that's a whole different story.
Yeah, we will definitely schedule that. I think you
Mhm.
can do a teaser video on that, and you and I can set up a time to talk about appraised values with new construction and the current market.
Actually, I would like to do a teaser video on that. So, but okay, hold on just 1 second. Let's go ahead and wrap up this conversation.
Yes.
So I can cut the video here, and then we can do a teaser video in just a second while I still have you.
Okay.
Okay, so that was Katie Andy with Interlink Mortgage. She's one of my favorite lenders. And if you're a first-time buyer, I definitely recommend going to Katie to find out how much you're qualified for and what it would take for you to get into a mortgage. In the meantime, this was Elena Garrett with Keller Williams Central, and I'll see you guys later.